Gee Taggar, welcome to Property Insights, mate.
Thank you. Thanks for having me, Mark.
You're most welcome. So you're the founder and managing director of Archer Wealth. Maybe just tell me a little bit about Archer Wealth. You know, where did that company begin, etc.
Sure. Archer Wealth, we're a private lender based in Sydney, Bondi Junction. Where the company began, that's hard to say. I started this in 2015 when I started my mortgage broking business. And the goal was really to start a bank. And that's where the journey began. And through friends and family and through mentors over time, it became, okay, well, first thing I want to do is solve problems that are imminent that I can actually help with. The key thing I found was there's a lot of, I'd say, issues that I saw with private lending. And that was a good segue for me to start and then eventually turn this into a bank. So everything we're doing right now is a structured way to go from where we were to where we are now. We've done around just over 500 million in the last 24 months. And that's direct result of just us following the process of going from a private lending firm to eventually a non-bank lender.
To a non-bank lender.
Yeah.
And do you have aspirations then to go from non-bank to
Yes.
ADI, like a bank itself?
Funny you asked me that. It's yes and no. Because my friends who are quite large non-bank lenders, they are guiding me into not going down the path of ADI because apparently it's you're going to be restricted and won't be able to do the things
I would give you the same advice as a non-bank lender. I would give you exactly the same advice. Well, like if you want to become a bank, that's cool because we need more banks in Australia. We need more competition, but the regulatory environment's pretty tough.
Absolutely. I guess the entire private credit exists off the back of
Yeah.
the restrictions that are put on the banks.
Correct.
I'm very, very aware.
So you don't want to lose the very freedom that you currently have that is making your business a good business. So private lender, not many people know what a private lender is. So private lender, it's a new term that seems to have been invented by the marketplace, particularly the
Correct.
commentators and the media. And of course, in some cases, banks don't like private lenders because they're stealing their lunch. And also, you know, you're a new form of lender. You're not really a new form of lender, but you're sort of forming a new industry. It never used to be an industry. Always been private lenders around, but they're has now become an industry.
Oh, absolutely.
Actually, an industry. So, obviously, you're lending money on one side, but on the other side, you must be borrowing money, unless your 500 million has come out of your pocket. So maybe you can explain where the money that you lend, where that comes from.
Sure.
How you raise that.
I'll give you a quick rundown on how we actually started. So back in 2015, I had no funds. I just had a dream, and it took me 4 years to get to a place in 2019 to be able to start lending money. Unfortunately, nothing I was doing was working, so I kind of got frustrated and leveraged myself and started lending my own money out. And then one of my friends' dad found out about it, so he invested 5 mil from his SMSF. And then another friend's dad came on board. So all up, we had just under 30 mil for a long time until 2021. Then we started raising money through structured warehouse facilities. Two of the top 50 AFR rich listers in Australia now back us. One of them has given us a commitment of 200 mil. So it's been just showing performance over time. And currently we're also going through a round of $140 million warehouse. So funnily enough, all the restrictions that are put on the banks, they're still our biggest supporters because we end up getting the funding from them anyway. It's just they're not restricted with APRA regulations when they're doing structured warehouse facilities. And that's most of the good private lenders in the country today.
Yeah. So what you're saying is that probably not all the banks, there'd be maybe one or two banks that do it. Probably Westpac and NAB definitely would be starters. The other ones don't really like doing this, but they give you a warehouse, which basically means they'll lend you wholesale money through their the investment part of the bank, as opposed to the retail part of the bank. And they'll give you warehouse money, but for every $100 they give you, generally speaking, they ask you to put a bit of your own money in or find the risk money. So, you know, if I lend, I think, just for our audience, I think what you're saying is, correct me if I'm wrong in your case, but a bank, retail, one of the big banks here will give you a warehouse, basically lending you money. They'll give you, let's say, 100 million, for argument's sake.
Correct.
They say to you, and these are the things we like you to lend for. So, they give you characteristics of the property, the person, whatever.
Yep.
But for every $100 you lend, we'll only fund $90, and you've got to find $10 of your own, or something along those lines.
A bit worse than that. So
Yeah,
that's why I said
but along those lines.
140 mil includes 10 mil of your hard money,
Yeah.
100 mil from the bank, and 30 mil is usually mezzanine lenders.
what they call
so
mezz.
many funds
Yeah.
that do that for us.
And then and the person you put your $5 million in that example, and you might say, I want 12% per annum. And the mezz might say, well, we're putting in the other 25 million or 35 million, whatever it is. We want, 11%. And then the bank who puts in the other 100, they might say, well, we want 8%. Whatever, it doesn't really matter. Then you blend all your costs.
Correct.
And you get a blended cost of maybe 10.5% on that example, something along those lines.
Absolutely right.
And then you can lend it. Then you go off and lend it to your customer, and you might lend it at 12, and you pick up the difference along those lines. That's sort of how you fund it.
Absolutely, yes. Just the margins are a lot lower and the rates are a lot lower. So the main thing we care about, I mean, it's funny, the business has changed so much, Mark. When I first started, you had this hierarchy. People will go to the banks, and most of our borrowers are either property developers or they are small to medium businesses. And they'll go to the bank, then they'll go to the second tiers, then they'll go to the non-banks like Bluestone, Liberty, Latrobe, and then they'll go to private lenders. What's happened, and what I find so interesting, is most of our clients are bankable clients now. I'll give you a great example.
What you mean by that is they can go to the bank.
They can go to the bank, but they don't. Why would you? Because the three things that we are amazing at, when I say we, I mean most good private lenders, is speed. We can do stuff within days and maybe a couple of weeks, not months. Certainty. When we say we're going to do the deal, we've already done the DD up front, we're going to do the deal. And then the last one is flexibility. And flexibility is a big one because a lot of the times banks are rigid in the way they operate through no fault of their own.
Yeah, there's covenants and all this sort of the complicated stuff.
Correct. So we don't have that. If the deal makes sense, we just go to investors and go, this is a deal, this is how we think we should do it. These are the parameters we're going to work in. It gets done within weeks.
So you don't have the money sort of sitting idly in an account ready to lend. You go on deal by deal. So like if you're going to lend to me, you go to me, you'll take my deal to your investors and say, are you in on this deal?
Correct.
And you've probably got a whole list of people who you can go and see. If this person's not interested, go to the next one or whatever.
So yes. So we have three ways we fund Archer Wealth. The first one is the structured warehouse that we have that we can draw on. We need 24 hours notice. The second one is peer-to-peer model where we have a bunch of investors or family offices. We go, hey, there's a deal. We need the funds within 24 hours to 48 hours. Because there are parameters, you tick the parameters, money just comes in.
Yep.
The third one is the fund itself that we have where the funds do sit there. We try to avoid calling money into the fund because it's the same investors, because then you pay interest on that. So our goal is always
You pay interest on that.
We do.
Yeah, that's right. While you're waiting to place the money.
Correct.
So it's negative carry.
Correct. So we try to be efficient with our capital. And that's most private lenders that I know of that operate in the same way.
So there has been a bit written about this stuff, G, and I dare say it's probably fueled by the banking system. But they're saying that there's private lending market is not dodgy, but perhaps is they're trying to equate it to the GFC. Like these guys lending money to people that they shouldn't be lending money to, and that somehow the whole thing's going to collapse. How do you reply to that? What do you say? Look, particularly if brokers are listening to this because they want to put their clients into this. So what do you say to that? What's your response?
Mark, here's what I'll tell you why I started. So I had a client, really old client. I felt bad. I'm from Melbourne, so this guy flew down from Perth to come to see me. Flew out from Perth to come to see me, and I promised him. And I was a brand new broker coming straight out of the big banks. I didn't know there was such thing as fraud at that level. This poor man came in and I gave him a term sheet from this supposed lender. The lender basically said, really great rate, really great LVR, but you just got to pay me 15 grand up front. And I convinced I did some research on the lenders. A few people said he was okay. Turns out it was all a scam. Basically, the guy took the money up front and then he just changed the terms completely to the point you couldn't say yes. And I remember just sitting there going, there has to be a better way to do business than that. And that's where I'm like, I want to try it. I'll do it better than this. And then as I've seen over the last 10 years, the industry is completely changed. When I see private lenders, there is still way too many sharks in the industry. And there is way too many broker partners that we also fund or white label, where they pretend to be lenders, but sometimes they don't necessarily do the right thing, where they just charge upfront fees and put caveats. That's really a wrong way to go about it. The thing I keep hearing, and I really, really, really hope it happens, is ASIC is now starting to look into the industry as a whole. I think it's a very, very good thing. Regulation is great because all it's going to do is weed out the bad players and make it cleaner. Now, there are a few really basic things, and I've written about that a lot myself. There's really basic things you can do when you are dealing with private lenders. Just basic due diligence. Like sometimes stuff like really low rate, really low upfront fee, establishment fee, but there's a huge upfront fee to get those. Doesn't sound right. Go to their website. Check their Google reviews. Sometimes they don't have an About Us page. You don't know who the actual person is that you're dealing with. So it's just basic due diligence that you can do.
If you're the broker or the borrower.
If you're the broker or the borrower, correct. And the second thing is, even if some lenders are legit, the main thing where people come unstuck is terms that are too onerous and people end up in default. I remember I was talking to one of my banks that is doing a warehouse, and he said even one of their lenders has what's called lender to own. So you're basically lending money to people to then buy their houses back because you're being aggressive in your recovery.
Oh, you mean if something goes wrong?
Yes. But the thing is, it's so easy to make things go wrong in the contracts the way they're written, which is why the unfair contract terms came into effect in November 2023. So ASIC is tightening up on this, and I really hope they do it quicker because the industry needs regulation, and I hope it happens.
So what's a typical borrower? Like, give me an example. Like, let's say I've heard these examples, and I mean, I got to declare early that you are on our panel, Yellow Brick Road panel. You're one of our panel lenders. So what about someone wants to buy a house for $30 million, for argument's sake, just a house to live in, but hasn't sold their other house for, maybe they're trying to sell a house for $50 million. They might just want to get a smaller house because kids are all left or something like that. But they need to sell the other house. They're asset rich, cash poor. Is that an example of someone who would borrow from you?
Absolutely not.
No?
Because that is exactly what ASIC is coming down on with lenders. I'm not sure if you heard about Oak, where it's basically these are coded loans.
Yeah.
You do not want to play in the coded space. Private lenders like us exist for two reasons. Number one, we're just helping developers. Number two, it's small to medium businesses. I'll give you a couple examples. So we had a borrower we settled 2 weeks ago. He ran his tattoo parlor from a basement in Sydney CBD in one of the buildings. He went to the bank, and the bank couldn't work out, the valuer actually couldn't work out how to value the property, and it just delayed the whole process. And the guy was about to lose the actual site because he was been renting there for 10 years and he needed to be able to buy it. Otherwise, they were going to sell it to someone else. Now, this example, we came in, we settled the deal we got the valuation, everything done within 7 days. So within 10 days, the deal was done just before the contract was about to expire. Now, in this example, the key thing I look for is what is the actual exit, because we are short-term lenders, anywhere from 3 months to 36 months max. In this specific case, it was a 12-month loan. I said to the guy, he goes, I just want the money for 6 months. I said, no, because you're opening yourself up to going into default. So rather give you 12 months and then you can get out in 3 months and that's okay. So the exit was the bank. So I actually making sure the guy doesn't get into trouble. So I called up his bank that he was dealing with to confirm whether or not they will take the loan. And they said, yes, we just need more time to do valuation.
Yeah, so that's what you might mean by an exit, someone to refinance the deal,
correct,
to pay you back. And because I think what people need to understand is that these are, relatively speaking, short-term loans.
correct.
And you want to, because you want to get repaid back in, as you said, maximum 36 months, whatever the deal is you've agreed, but you want to make sure you get repaid. Part of your your due diligence or your assessment is being convinced that the borrower has an exit,
Correct.
has the ability to exit. Maybe they're in a solar property, or maybe they're going to sell another property, or at least they've got assets that they can sell.
Absolutely.
Or they've got super or something's there that they can actually, get liquidity from. What's your minimum loan?
You can borrow like 100 grand.
Oh, really? Okay.
Yes.
And
Prefer
always
not to do it, but it's
always secured.
always secured.
Yeah.
So maybe I should expand a bit more on what private lending is in general. So private credit is a term that gets thrown around a lot. As per RBA, it makes up 2.5% of total business debt in Australia, which is around 1.6 trillion. But that's a $40 billion number, which I don't think is right, and neither does EY. EY estimates it to be at 188 billion, which includes corporate debt. But what we do specifically is secured against real estate. That part of the market is around 78 billion is what EY estimates, which I think is about right. So they're saying it's going to double in the next 5 years, which doesn't sound unreasonable considering I've seen it 10x in the last 10 years since I've been at it. So for me, there's two things that make up a private loan. The purpose of funds has to be business use or commercial development or property development. And the borrowing entity has to be a corporate entity. So these two things are the key things. And the term's always short, anywhere from 3 to 6 to 12 to 36 months.
Right. And your rates? I mean, you don't have to.
I can tell you. So
what's the range?
The range would be, so right now I'm thinking, because the rates have come down so much, if you're paying, say, a bank 6.5% on an interest-only investment loan, you'll be paying a non-bank 7.5%, like Latrobes and Liberties and stuff. You'll be paying us between 7.5 or 7.99 to 8.99. So the rate difference is not actually huge.
Yeah.
But what it makes a difference is when you get the money, the speed is there, the certainty is there, and the flexibility is there.
Yeah. So you're really like private lending is sort of like short-term lender.
Correct.
Or short to medium, perhaps. I don't know. It depends, but definitely short-term lender. So it's a bit of a stepping stone for them to get full finance down the track.
Absolutely.
Either that or liquidate the asset completely. They got some sort of plan.
Absolutely.
So yeah, because private lender just has all sorts of connotations. It's actually a crappy word. You really nearly need to come up with a new word.
Or we call it non-bank lending, which is a more nicer
acceptable
term.
Yeah, non-bank. You're not a bank. You're a lender.
Correct.
Yeah, not a private lender, because private lender sort of has all sorts of connotations. Like
Correct.
You're going to get stitched up and stuff like that. And now brokers, they have access to your product.
Absolutely.
Yeah. So you're on pretty much all the brokers panels. You're on a lot of them.
No. So here's the thing. YBR was the first lender we wanted to be on the panel with. And the reason for that was up until now, we didn't need to be on broker panels, on lender panels.
Yeah.
Because it was just so easy for us to give you a great example. At the moment, we look at between $400 to $500 million in deal flow every month.
Wow.
It's just because there's so much business out there. And I'll fund maybe 10%. That doesn't mean there is around 90% is rubbish. It just means we only want to fund 10% at this stage, and we'll jump it up to 20% as we grow. Now, having said that, there was no more capacity for me to actually get onto another aggregator panel, and when the opportunity came up, it was a very thoughtful decision, because for me, I value helping small to medium enterprise businesses. I know you guys do. I know you personally do. So I wanted to align myself with organizations that are in the same mission as I am. And that's why we're here.
Okay, excellent. So I should tell everyone that you can go to the YBR our website. You can go to YBR branch or generally, and we do have this Archer product on our panel. It's been successful, and we endorse these guys. So I appreciate your honesty and your upfrontness today, mate. And thanks for introducing the audience to some of which are borrowers, some of which are brokers, and some of which are small business owners. But thanks for introducing us to the world of private lending. It's here to stay. Whether that's the right name for it or not is another matter, but it is here to stay, and you guys do a great job.
Thank
and by the way, you're occupying a territory the banks don't want to occupy, which makes sense to me.
Absolutely.
Everybody's entitled to borrow money if they've got a good purpose.
Absolutely. The gap which private lending fills is simply this. When the banks pulled out of funding developers because their income is too inconsistent and small to medium businesses, that is literally why the private credit industry kind of popped up in Australia. What's so interesting for me is in US, it accounts for 50% of
Wow.
all lending. And in Australia, it's 2.5%, according to RBA. I know it's more, but my goal is to hopefully at least come past 10 to 15% of total lending, because majority of it is still controlled by banks for good reason.
Well, stay in the non-bank sector, mate, because we need more people like you. And stay away from the banking sector. Gee Taggar, founder and managing director of Archer Wealth. Thanks very much for coming in.
Thank you
Mate.
so much, Mark. Thanks for
Appreciate
having
it.
me.